Hello and welcome to Market Square, your go-to show for deep insight into business and economic trends. I'm Olaiton Adebayo, and today we focus on a major headline: Nigeria's inflation rate has dropped after the Consumer Price Index rebasing. While inflation is slowing, prices remains high, and the business community is watching closely as government policies shape future trends. Will this drop bring about lasting stability, or will it be short-lived? Stay tuned. Welcome back to Market Square. Let's get straight into it. Nigeria's inflation has taken a significant turn, dropping to 24.48% in January 2025, following the rebasing of the Consumer Price Index by the National Bureau of Statistics. Just a month earlier, in December 2024, inflation stood at a staggering 34.80%. That's a remarkable decline, and it's raising a lot of questions. What's behind this shift, and what does this mean for businesses, consumers, and policymakers? The Statistician General of the Federation, Adeyemi Adeniran, broke it down in Abuja while presenting the rebased CPI report. According to him, the All Items Index, which measures headline inflation, was at 110.7 for January 2025. The key drivers are food and non-alcoholic beverages, restaurants and accommodation services, and transport. These sectors continue to play a crucial role in the nation's inflation trends. But now let's talk about the rebasing. Why was this necessary? Well, it's been over a decade since Nigeria last rebased its CPI, even though this exercise is typically conducted every 5 years. The previous base year was 2009, which meant our inflation tracking was outdated and did not fully capture recent changes in pricing, household consumption patterns, and economic shifts. The update to the 2024 base year ensures a more accurate reflection of the rising pressures in today's economy. The NBS has adopted the classification of individual consumption according to the proposed 2018 version, making household expenses categorization more precise. This upgrade also brings in new special indices to improve inflation tracking. For instance, we now have a farm produce index of 10.50%, an energy index of 8.9%, a services index of 10.41%, a goods index of 10.79%, and an imported food index of 11.47%. These additional indices give a more nuanced picture of the price changes across different sectors. Looking at food inflation, the numbers show a significant drop. Year-on-year food inflation for January 2025 was recorded at 26.0% compared to the alarming high of 39.84% in December 2024. Urban inflation stood at 26.09%, while rural inflation was slightly lower at 22.15%. Core inflation, which excludes farm produce and energy, settled at 22.59%. While the lower inflation figures offer some relief, the cost of living remains high and the impact of inflation continues to be felt across various sectors. The effectiveness of government policies, including monetary tightening by the Central Bank of Nigeria and fiscal interventions aimed at stabilizing prices, will be very crucial in determining future inflation trends. Now let's talk about the credibility. Anytime major statistical adjustments happen, doubt is bound to happen. This rebasing involved extensive consultation with the key stakeholders, including the Central Bank of Nigeria, the International Monetary Fund, the World Bank, the United Nations Economic Commission for Africa, Budget, and the Nigerian Economic Summit Group. The Statistician General was very clear that this is not just a manipulation of numbers, rather it's an effort to present a more realistic measures of price levels and economic trends in Nigeria. The drop in inflation could signal improved economic stability, but it does not necessarily translate into lower prices in the immediate term. Instead, the slower pace of inflation means that prices are rising at a reduced rate, offering some relief to households and businesses struggling with high costs. The business community will be closely watching how the government navigates inflation control measures while ensuring sustained economic growth. The CBN's monetary policies, exchange rate stability, and fiscal strategies will also play a key role in shaping the rising price pressures in the coming months. So what's next? With this new inflation measurement, we'll have to wait and see how the economic response, will policymakers adjust their strategies, how will businesses and consumers react, and most importantly, will this decline in inflation translate into relief for everyday Nigerians? Now move to the second headline. The Naira has been on an impressive run, gaining 9% against the dollar. Just a few months ago, we were looking at an exchange rate of 1,662 Naira per dollar. Fast forward to February 13th, we are at 1,509 Naira, and that's the biggest gain among African currencies in January alone. In January alone, it's climbed another 4%, reaching a 7-month high of 1,478 Naira per dollar. The last time currency appreciated in the month of January was in 2012. But as with all market movements, the rally has slowed down a bit in the February. Right now, we are seeing a bit of stability around 1,500 naira per dollar in the official market. But in the parallel market, the naira is still holding strong, trading at 1,545 naira per dollar, up from 1,620 naira at the start of the month. Now, if you're thinking, have we not seen this before? You're not wrong. Let's rewind to March 2024. The naira surged from 1,600 naira per dollar in February to 1,300 naira per dollar, fueled by strong foreign portfolio inflows and diaspora remittances. But what happened next? As dollar inflows slowed, the crack started to show again. By July, the naira had not only lost all its gains, but had dropped to an even weaker 1,660 naira per dollar. So what's the big question? Will history repeat itself? While the Central Bank of Nigeria seems determined to avoid that, this time around, they're making a more measured approach. The naira's performance in February suggests a more controlled strategy rather than a sharp, unsustainable rally. One of the game changers in this resurgence is the electronic foreign exchange matching system, which was introduced in December 2024. These systems allow authorized dealers to place anonymous orders into a central limit order book, making the FX market more transparent and ensuring better price discovery. Another key reform came in January 2025, the Nigerian Foreign Exchange Code, or the FX Code. This set of principles is designed to ensure ethical conduct, governance, risk management, and execution in the FX market. And guess what? These measures are bringing Nigeria's FX market in line with the global best practices. That's a big confidence booster for investors. But even with these positive strides, there's still a challenge. Nigeria's external reserves are shrinking. As of January, reserves had fallen to $39.4 billion, and the reasons are significant outflows, including repayments of Nigeria's COVID-19 IMF facility and CBN's intervention in the FX markets. The CBN is considering publishing net external reserves data that will bring more transparency to Nigeria's actual FX liquidity, a long-standing concern for foreign investors. With the naira in uncharted territory, the next few months will be very crucial. Is this rally here to stay, or is this just another short-lived spike? Only time will tell, but one thing is for sure, the FX market is watching closely. Now we'll move to the third headline. Nigeria is set to unlock its vast non-associated gas fields, which are valued at a staggering $257 billion. These gas fields, estimated at around 106 trillion cubic feet in total, account for 51% of our nation's total gas reserves. Despite this immense potential, non-associated gas currently contributes only about 39% of our daily gas output. Under the Nigerian Tax Bill 2024, the government is introducing a series of tax incentives designed to encourage investment in these underutilized resources. Let me break it down for you. This new scheme offers tax credits calculated based on the hydrocarbon liquid content of each gas field. For those fields producing up to 30 barrels of hydrocarbon liquids per million standard cubic feet, companies are eligible for a tax credit of $1 per 1,000 cubic feet, or 30% of the fiscal gas price. Fields producing between 30 and 100 barrels per million cubic feet can receive 50 cents per 1,000 cubic feet, again capped at 30% of the fiscal gas price. Fields producing more than 100 barrels are excluded from these credits. These incentives are specifically targeted at onshore and shallow water non-associated gas development. They are available for projects that achieve their first commercial gas production from the enactment of the Act until January 1, 2029. And once production begins, the gas tax credit will be applicable for 10 years beginning from the date of first gas production. And now, why is this significant? Nigeria is recognized as having the 9th largest gas reserves in the world, estimated at roughly 209 trillion standard cubic feet, but the potential of non-associated gas remains largely untapped. By offering these tax credits, the government is aiming to create a more attractive investment environment, one that not only spurs new projects, but also helps to overcome the infrastructure challenges that have historically held back production in offshore and shallow water areas. Data indicate that the Shell Petroleum Development Company stands as a primary beneficiary of these tax credits, given its position as Nigeria's largest non-associated gas producers. However, as Shell finalizes its acquisition processes, the Renaissance Consortium is poised to take over these benefits, setting the stage for increased competition and innovation within our gas sector. This initiative brings about both promising benefits and significant challenges for Nigeria's economy. On the plus side, these tax incentives could significantly boost domestic gas production, enhance energy security, and reduce our reliance on imported energy. Increased production is likely to drive job creation, foster technological innovation, and ultimately contribute to robust economic growth. However, there are some hurdles to overcome. The success of this incentive will depend on effective implementation and addressing existing infrastructure challenges. Global price volatility could also affect the expected production boost. Reduced tax revenues may also place pressures on government finances, potentially impacting spending in other crucial areas. It's a delicate balance. While these incentives have the potential to unlock enormous value, they require careful management and strong regulatory oversight to ensure that long-term benefits surpass any short-term drawbacks. This comprehensive strategy to tap into Nigeria's non-associated gas reserves is more than just a policy shift. It's a strategic move towards a prosperous energy future. By unlocking these vast non-associated gas reserves, Nigeria is positioning itself to boost domestic energy production, reduce reliance on imported energy, and ultimately drive substantial growth in our economy. As we look to the future, it's clear that the success of this initiative will depend on continued reforms, sustained investment, and the ability to leverage our natural resources effectively. If this tax incentive perform as planned, we could see a significant rise in gas production, paving way for a more secure and prosperous energy future for Nigeria. Now move to the international news. In a significant development for Eastern Mediterranean Energy Corporation, Egypt and Cyprus have just sealed some major deals that could shake up the regional energy markets. This agreement focused on exporting natural gas from Cyprus's Kronos and Aphrodite fields straight to Egypt, where it will be processed and shipped to international markets, including Europe. The first deal results around Kronos field. Gas from this field will be piped directly to Egypt, where it will be liquefied and prepared for export. This agreement marks a collaboration between Egypt, Cyprus, and a consortium of energy giants, Total of France and Italy's Eni, playing an essential role in the process. The second deal centers on Aphrodite gas field, first discovered back in 2011, which is estimated to hold around 4.5 trillion cubic feet of gas. This agreement outlines the framework for developing and monetizing the Aphrodite deposit. With Chevron, NewMed Energy, and Shell as the key partners, the gas will be processed in Egypt and could be used for both domestic energy needs and exports. Cyprus President Nikos described this agreement as game changers for regional energy cooperation, stressing their strategic significance. Egyptian President Abdel Fattah el-Sisi expressed optimism about the future of energy collaboration between these two nations. But why does this matter for Egypt and Cyprus? Well, for Egypt, this could not have come at a better time. The country is looking to strengthen its energy sector, especially as domestic gas production has been on the decline. By tapping into Cyprus energy, Egypt is reinforcing its role as a regional energy hub, a move that could boost its economy and influence it in the global energy market. For Cyprus, the deal is just as significant. The island nation has been sitting on these gas reserves for many years, looking for the right opportunity to monetize them. With this agreement in place, Cyprus is now in prime position to export its gas, attract investment, and enhance its geopolitical standing in the Eastern Mediterranean. Together, these agreements are a win-win for both nations. They could not only enhance the energy sector of Egypt and Cyprus, but also drive economic growth, improve regional cooperation, and pave the way for both countries to play more influential roles in the global energy landscape. Nigeria's economy is at a crucial junction. With the Nairo's strong rally continue, can inflation keep its downward momentum? With external pressures and policy shifts at play, the future remains uncertain. That's a wrap for today on Market Square. I'm Olaitan Adebayo. Thanks for tuning in. Join us next time for more deep dives into forces shaping Nigeria's economic future. Until then, stay informed and keep thriving.